Hi, everyone. Welcome to the TimingResearch.com crowd forecast news for December 18th, 2023. We are recording this at 1 p.m. Eastern Time, and this is episode number 412. We have a special option professor solo market outlook and top ideas for 2024 episode for you today. So you should be seeing the option professor screen right now, and I'm going to go ahead and turn it over to him.
Okay, thanks a lot, David, and welcome everybody on this Monday morning. Again, I think we're in our ninth week in a row of rally. So I'll be explaining how we saw that and how we shared that with people a little later in the broadcast. Before we get started, I just wanted to make sure that information I'm going to be providing is opinion and observation, and that we are not giving any advice out. We tell people to go to their brokerage firm so you guys can figure out your suitability, and also that's where you would do your business. So what I'm sharing with you now is just insights, information, and opinion that I see things going on right now. With regards to my background, option professor, I've been doing this for decades. I've taught people at seminars throughout the country for decades, and I'm very familiar with the uses and risks of options, so I'll talk about that a little bit. But obviously, with my portfolio, I'm not doing just options. So I'm going to tell you what I think is good ideas for income. I'm going to be talking about what sectors look good, things that I've been involved in that I think may continue, and where and if there could be any warning signs here on any of this market, because obviously there's been a stampede into the markets here. And so stampedes sometimes continue, and then sometimes they obviously stop. The higher something goes, obviously doesn't make it less risky. So the bottom line is that we have to be concerned always, if you're managing money, that you don't want to, get caught holding the bag, because obviously the news can change. Right now, we've had a big run up because we're looking for all these cuts in the interest rates this year, and they're acting as if the cuts have already occurred. So the bottom line is there's a risk to that. But right now, as we go into the end of the year, what I've been telling people is the CTA crowd seems to have covered all their shorts and started going long. They tend to continue to buy after they start buying long. So that is obviously very good for the short run. And that's why we're going up here today as well. Again, trying to find sellers in this environment is not easy, because who wants to say they sold out of the stock market that goes up 9 weeks in a row? Not too many. So you got a lot of people on one side of the boat. And of course, that's why you're seeing such an easy way up. And we're trying to take out the high today. So 4,808, 4,808 has been the high. Let's put up the SPX, because that's the cash index more. And we'll see what that looks like. And that is trading at 47.43. So that's got a little bit of real estate to go before it gets up to the high, which is 48.18 in January of 2022. But obviously they look like they're trying to make a run at that. So that's what's going on right now. Okay, so today, again, I'm going to be going over what looks great, in my opinion, for next year. And of course, review some of the stuff that's extended and get you some idea when you might be concerned if it starts rolling over. And then, obviously interest rates have dropped. So people that are in money market, obviously they're at risk of having to reinvest their money if they do bring the money market accounts down to 3 or 4%. Where would they go to try to find income? I'm going to cover a couple of those things as well. So let's get into it and let's get started. And I'm going to go over overview of the big indexes that people probably have money in: the S&P, the QQQ, the SMH, and the IWM. So that gives you the S&P 500. It gives you the NASDAQ. It gives you the semiconductors, which have gone nuts, and also IGV, which is software. And then also we'll give you the small caps, which are starting to get a bid as well. Okay, so let's start out with the S&P, and I'll show you my analysis of it. Okay, first of all, we were telling people that this 4,100 area is just absolutely very important, and that is the area where it had to hold. And if it does hold, with all these moving averages pointing up, the risk of a big move to the upside was clear. Okay, on my 5-year graph here, my moving averages got hit exactly. Do you see right there the purple line? What was the low in October 23rd? It was 41.03. Where was the purple line? 41.05. Not a bad place to buy, correct? And of course, these averages are pointing up. And so that's why you've been accelerating to the upside. The other thing is the RSI, when it went down here, never really broke the 40 level. That's the neighborhood you have to hold if it's going to stay bullish. And watch, it starts going up and it goes to 52. If it goes through 60 substantially, you're going to accelerate to the upside. And you can see it goes into the 60s right there at 4,400. And what did I tell you? If it goes through the 60s, you accelerate to the upside. You think 4,400 to almost 4,800 in like a few weeks is accelerating to the upside? So we've been all over this thing. And people that have talked to me at the end of this broadcast, I'll explain how you can speak to me directly. But the bottom line here is that we were all over it. We got it right. And people who took the time to speak to me, we're very, very happy that they did. Okay, so that's the story right now. And that's the long-term charts. Now, again, one thing that's kind of concerning is the RSI here was 70, right? And that was on July 17th. So the last time we made highs on it, and that high was like 45.78. So right around 4,600. We made highs and the RSI was what, 46.07, and we were at 70. Now we're way the heck up here and the RSI is still only reading 67. When you make a big new high and the RSI doesn't make a big new high, that is what they call a flag that the market's running out of steam. That's not a reason to sell. It's a reason to be looking for a reason to sell. And the reason to sell would happen when the moving averages turn down. Okay, so right now we can see that there's evidence of a shall we say, an exhaustion in the RSI with this new high, which means it could be a lot of short covering or light volume or something along those lines. So now we switch to the shorter term graphs and we got our 1 year way up here. And let's see, you got a 79 RSI on that bar, and then the new high got an RSI of 80. So let's keep an eye on that because 80 and 79 are pretty extended. So if we have a correction back down a little bit and then it rallies back up and you don't see 80 on that RSI, but you see something like in the 60s, like say we got a pullback down here a little bit and then it rallies back up, that would be your time when you'd have a pretty good idea that it's exhausted. But these averages are all pointing up and you got a big gap down here that probably is going to get filled at some point. Got a big gap down here, you got a big gap down there. Show me gaps that don't get filled ultimately. Most of them do. See this little gap here? That was in June of 23. Well, by what? By the next year, it got filled. Okay. So the bottom line is gaps do get filled at some point generally. So looking later in the year, if things don't pan out as everybody hopes, these would be attractors. Okay. But not right now. Not right now. Okay. So that's basically the story on the 1 year graph. Now let's go to the 1 month. This is the one you more do the trading off of because obviously it's giving you your indicators much quicker. So if you're doing shorter term trading, this is the kind of stuff that we look at. So the bottom line is that this thing, blue line, rise, 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 everything's fine. Where's your RSI here? 89. Where's your RSI here? 74. My guess, this thing's coming down on a short-term basis. Why? Because you got a divergence there. But the RSI, the red line's not pointing down. So I would be of no interest in selling this thing on a little bit of a longer term basis until this thing turns over. Is there any evidence on the 5-day? Again, you got your RSIs up here, 86, right? 86. And then what? You come on over here and it's 68. Remember I told you if it gets softer, boom, you get a pullback on a trading basis. But these moving averages are under the price and they catch the falls, right? So right now you're up here at 68 and 67, okay? No evidence of a rollover that you can look at, really. Have it on the 1 day. Say you're day trading. Really, I got nothing here. You got to have the red line pointing down, or you're going to be hoping against hope. So that's not what we do around here. So no real evidence, but there's some concern that there's divergences that are indicating that we could be running out of some steam. Okay, but no evidence on my moving averages telling me anything other than you're extended. And at some point, you're going to do a reversion to the mean. In other words, on the 20 year, you're down here on the moving averages at 4,200, 4,300, and we're the way the heck up there at 4,800. So a reversion to the mean risk is totally there. Now we're talking about the 5 year. The 5 year has the purple line down here under 4,200, and everything else is around 4,400. we're up near 4,800. Again, that's extended. And so obviously, I mean, if somebody said, what should you do now? Well, if you haven't done anything, you know what I tell you? It's too strong to buy, excuse me, too high to buy and too strong to sell. So you know what you do? You don't do anything. Where should you have gotten in? Where we were talking to you about at 4,100, where we were talking to you about at 4,300, and where we were talking to you about at 4,400. And you should be just what? Getting a big rake and collecting your money. Okay? So that's the story there. But everybody wants to always give you a current idea. You got to do it today. You got to do it today. Listen, today is not, and these are all my opinions and my views. Okay? They're not giving you any advice. I'm just telling you what I'm thinking. Okay, so that's the story on the S&P. So in summation, what would I say? I would say it's extended. I would say it looks like it's running out of some steam potentially. I could say that it looks like it wants to take out the high. Could it keep going in this environment where everybody is absolutely thinking the Fed's going to cut like crazy next year? Really? Really? Do you see how holiday sales? They're going through the roof. Now, you don't have to worry about spending money because Clara, or whatever they're called, they'll loan you the money on buy now, pay later. And so will that company firm. Okay, not to mention all the credit cards. So, they're going on smoke and mirrors here, but they're going because everyone's got a job and they can make the minimum payment. I think that's what's going on out there. And until that stops going on, again, thinking you're going to slash interest rates, I think is a little like Williams said and Bostic said, a little premature. And premature is what they're pricing in right now. Okay. And again, people get excited and the salesmen get excited and these firms get excited. And it's exciting to see your statement rise. Okay. So that's why the VIX is at 11 or so. That's why credit spreads are at 3.65, which are ridiculously tight. What does that mean? Credit spread means that the difference between the treasury, which is guaranteed by the government, and they can print money to pay you back, is not that much of a difference than a junk bond where you're loaning money to a company that is not exactly great credit worthiness. That should be a wider spread, but it's very tight because everyone is extremely optimistic. Just like they were extremely pessimistic 8 weeks ago when we were at 4,100. So I know the winds of change blow because I've been doing it for decades and decades. Okay. All right. So that's the story on the S&P. Let's swing it over to the Qs. And I'm going to give you some option ideas as well here, as far as, some theoretical or not theoretical, but just some ideas that, if you thought something would happen here. Okay, so the Qs, obviously, they're also going, let's start with the 20-year on the Qs. They're also trying to go after their highs. The high there on November of 2021 was 408. We are now trading at a high of 407. So knock, knock, knock on the door, baby, right? So this thing turned up, obviously, right here at 300. You should have been long the whole time. What should you do up here? Again, you like to play for the extended move. Good luck to you. This is not the way I would think is the most optimum time. RSI, look at this. You're at 77 on that high, right? And look where your RSI is here, 64. Do you understand where there's a risk here that we are going up on a lot of short covering and lighter volume, and sometimes that dries up. So again, it's not a trading strategy. It's what they call a warning sign. Okay, and I like to listen to warning signs. I'll show you the reverse here. You see here, remember I told you if you can't get under 40, that's going to be the bottom. Look at the RSI here, 42. Look at it down here, 44. You've got a higher RSI and a lower low. That tells you you're running out of steam on the sell side. Was that a good time to start looking at the buy side? I guess it was. So again, I'm not guessing down here. I use this data. All right. Looking at the 5-year graph. Okay. The high point over here is RSI of 63. And then over here, your RSI is at 70. That's bullish because you got a higher RSI. So not every signal is going to be in uniform. And again, I don't want to get into some selling of anything until I get some evidence of the red line turning down. So I don't have any evidence of that at all. What I do have evidence is that the purple's way down here at 330 and the blue's at 360 and the red is at 380 and we're way the heck up there at almost getting to be 420 before you know it. Okay, so it is a bit on the what they call extended side. On the 1 year on the QQQs, there you go. You're up at a high here, 77 RSI. And so again, RSI is up in the high 70s. No, nothing, obviously now you got a gap here and you got gap, same as the stock market. So is that going to be filled at some point later in the year, later in the quarter? Again, when you get big Januaries and Februaries in the stock market, historically the VIX is in the 20 neighborhood. Okay, the VIX is at 11 or 12. So that means you're entering the year in an excited fashion, in a very complacent fashion, and that is not generally how it goes into January. And so it'll be interesting to see if we pulled forwards our gains, and in the next 90 days, January, February, March, the returns are not very robust because we use the gains here in in November and December. Okay, that is something that I'm very much considering because, again, the trees don't grow to the sky, although it looks like they are doing it now. Okay, so again, looks great. Where you should have gotten in? Way down here. So you should just be taking the rake out and raking in the dough. Now let's talk about the 1 month. Okay, the 1 month, there's no evidence. Look at the red line. I mean, you get a board here at 388, ride the elevator all the way up. You're gonna need divergence, RSI 84, that's kind of high. RSI 72, that's kind of low. And now you're at 70. So you got a reducing RSI. I'm obviously going to be looking for a place to sell because this RSI is telling me we're running out of steam. So when that red line starts turning down, knock on my door. And that red line comes in at 404. So the bottom line is that, we need it to roll over and point down like it does when it goes down, right? It goes down when it goes down. And that's what I'm looking for right now, but I don't have it yet. So you don't do anything. You don't stand in front of a freight train. Again, a freight train. Again, a freight train. Starting to get under. If you're a day trader, it did break the red line here, but it's not pointing down. When it points down, then I will entertain the idea of the sell. And obviously, you could have a decent pullback on the day thing. So again, you got to wait for evidence, price evidence that the trend has changed. If you don't want to wait, you can lose your money. All right. Let's talk about so QQQ. Again, same story. Too high to buy and too strong to sell, and no evidence of a turn. What do we have evidence of? We have some evidence of the RSI divergence indicating that we're running out of steam. Running out of steam is your first signal. The red line pointing down is your maybe it's time to act. Okay, not maybe it's time to act. It is time to act when it points down. Okay, so again, that's what the story is on the NASDAQ. Let's talk about a short-term trading situation that a lot of you guys do because it's Monday, right? So they got options that expire on Friday. Let's take a look. AAPL. Everybody knows Apple. So let me show you an example using Apple. Apple's a nice high price, but it's down today. Why would it be down? I'll tell you why it's down. Because last week I entertained puts, and now they're going to be working for me, and I'll explain why I did it. Okay, so here you go. You got a high point there of 73. Now we're way up here, and it's 62. That tells me we're running out of steam. Not unlike Exxon, which I did puts on as well, up at around 120. So here we go on the July, and now we got 62. If you can't get through this low 60 area, that's the top. Okay, because there's an acceleration phase past here, right? That means you're going to blow through 200 and go to 210 or 220 as the RSI shoots to 73. But if it can't do that, that means there's no acceleration phase ahead, and that means what? You're at a high point. That's why I saw it. That's why I played it. Okay, so here's the deal. We know it's extended because look where the RSIs are. I mean, moving averages way underneath. Now let's go to the 5-year. You got a high point here of what? 74. High point over here, 62. I know basic math. I know 76 is higher than 62, and that means we're running out of steam. That's door number 2 to tell me start looking at the puts. 1 year. Okay, come down nice here today, but it's being held. So this is support right around one. Look at the low, 194.39. Red line 194.46. So you had a nice little move down there. Okay. But don't kid yourself. Short-term options that got in at 200, when it drops to 195, they're going up. Okay, especially like I say, if they're short term, but they don't have much time, time value to, volatility premium to go through. Okay. All right. So now where could it drop if it drops? You got the green line down here at 192, and you got the blue down here at 187, and those would be targets, right? If it can break, if they can break it, right? Okay. Now you go to the 1 month graph, and what do you got? Okay, you got the red line turning down, but not a lot, not a lot. But you had a nice divergence up here, I believe, and that's where I took my shot. Right now, obviously, they've already gone up in price. So the bottom line is that that's where you get your indication. But you need this red line to point down, and you need it to not hold this 95 area. Okay, so if you can get the red line to point down, and let's see what the RSI is doing. The RSI came down here to the low 40s. So this is a neighborhood where it would stop if it's going to just be a little dip and then go right back up again. There's a gap there, so it's possible you are going to go back up again. But if it can stay under the red line at 197.18 now, the longer it does that, obviously the red line can start coming down even further. And the next time it blows through 195 is probably a good sign that it might be giving up the ghost. 5-day basis, this thing's pointing down, and you're underneath what? But it's holding purple. So again, sometimes these numbers all coincide. Can you see the purples right around 195? Can you see on the 1 month graph? You have blue at 195. Can you see on the 1 year graph? You got red around 195, 194. So they coincide sometimes. And that's why I like to look at all the different time frames. Okay. All right. So anyway, but again, you got them all inverted to the downside, which, is not the greatest sign on the 5-day basis. So this thing is definitely weakened in the last 5 days. How about on the 1 day? Is it turned up? Yeah, you got to buy. See, you would have been going into this thing sell, and the red turned up right here at 194. So again, it is favoring the upside on the day trade right this second with a target maybe of 196.40. But again, let's start looking at the options. Let's just give a theoretical that you thought, well, we'll play it either way. Let's play it either way. Let's say you thought it was going to go back up and go test the high again. Let's go over to the option prices here and investigate. And a lot of people like to sell these short-term options, and God bless you if you do. I know the statistics. I've been doing it for decades. Obviously, a lot of these options can and do go to zero, but also they are limited in your return. And when you are wrong and you don't get out in a timely basis, they can go up very, very dramatically and not only wipe out your prior gains, but get into your principal. So the selling of the options, again, has a nice mathematical excitement to it. But again, if you win 8 or 9 times out of 10, but the 2 or 1 time that you lose is a big loss because they can expand however they want to expand, you may find that the math doesn't work so well. So I like to have a limited risk situation where I put up a peanut and I try to take out a cashew. So let's talk about that. Okay, these expire on Friday. So let's say right now we're at 195. It went down to the 195 area and held. And now you're going to make a statement that it's going to go back up towards, it's going to take out the high and go to maybe 203 by the end of the week as it has a big rally. Let's say it goes up $10 in the next in the next bit of time. You go a little bit out of the money and you go to the 197s and it's 85 cents. So the maximum risk on this option is $85. If it pops to 200, which it just came down from, retest the high, $85 would have an intrinsic value of $250. You take the target price of 200 and you minus your strike price of 197.50, and that's $2.50 in the money. So that's $250 intrinsic. Maybe you get extra, right? That'd be called the implied volatility value, but at least intrinsic 250. And if you put up $85 and it goes to 250, that ain't a bad pop. Okay. All right. So there you go. But say you think it's going to go back down, and now we are at 196, and you go take a look at the put side, and you take a look at the puts at 195 or even 192.50, because you think there's going to be a substantial drop towards, say, 187 by the end of the week. Well, if you put up 43 cents, that's $43 you're putting up in risk, right? And then if it goes to 190, it's in the money by 250 bucks, right? You have the right to sell at 192.50. The target price gets hit at 190. You're in the money $2.50 times 100 is 250 bucks. If you put up 43 bucks and it goes to 250 bucks, that's not a bad pop. And, that's not a bad pop. Okay. So that's why some of these short-term options are interesting to me, because I don't like to lose a lot of money on a option. And these options are fairly inexpensive. And then if you get volatility, the big if, they obviously can expand pretty dramatically because they don't have a lot of time premium in them. Okay. If you notice, the 192 put here is up 34% today. The 195 puts are up 44%. So again, people who bought puts last week, and I mentioned the fact that I did, they are enjoying a pretty good pop on their equity, right? So bottom line is that's why they make sense. Now you can see also on the call side, these options are down quite a bit. So people who bought calls last week, they're down quite a bit on a percentage basis. So these options are very risky because they are very short term. They are very risky because they're volatile, but they are limited risky, and that's what I enjoy about them. And again, you're using risk capital you don't need. Capital you is money you could throw up in the air and it wouldn't bother your lifestyle. And so that's why the appropriateness of this is determined by your brokerage firm. That's why I don't give advice, because I don't know you people out there as far as what your circumstances are. So that's why I'm making it as clear as a bell. This is not something I'm telling anybody to do. I'm showing you how it works. You and your brokerage firm will determine what makes any sense for you. Okay, but you can see just by the red numbers here today, these things can move both ways. And so there's your risk if you're on the wrong side, and here's your reward if you're on the right side. That illustrates a little bit of why I find them interesting as a speculative tool. All right, guys. So let's go back and do what we were doing here. And let me see how I can go back to the chart. Okay, let's go back. I guess I can go back up here and I go to the interactive chart. And let's see what I get here. Okay, I don't want that chart. Let's go to the snapshot chart. Okay. This will be better for me now because I can go back to my charts. And then I'm going to start getting into other stuff. I'm going to give you, I'm going to pick up the pace here because I only got 30 minutes and I got a lot of stuff to cover. Okay, so let's go. I went over QQQ. Let's go over SMH. That's where everybody's in there, right? Because they've been doing great. Let's see how great they look now. And again, the reason the semis and the tech is not, I'll get into that in a minute. People are rotating their money into the stuff that's not juiced up already. Okay, so let me, again, you got a high point surrounded by lower highs here. That's, that sometimes is a turn. Let's look at how this thing looks. Again, RSI here is at 84, RSI up here is at 65. That makes me concerned on a long-term basis that we're going to have a much different January, February, and March than we see now. And that's why I'm not loading up here and finding out I'm holding the bag. That's my opinion. Okay. All right. So anyway, because I can see the RSI is diverting, and I can see how overbought it is. Okay. So again, and then right now, where are you at here? You're at 60, 68. All you can say here is too high to buy, too strong to sell. You got to turn here potentially, because now you can, if you were a seller, you want to play aggressive, that's your defending point right there at the high, 175.86. That's where you defend if you want to be negative. On the 1 month graph, again, the average hasn't turned down. Now, did you have a divergence? 78 against what? 79 against what? 71. Not too big. So, I wouldn't be too excited again until that red line starts pointing down. You got gaps underneath that could be filled. On a 5-day basis, turn down, and right now you got to keep this thing under the red line, which is 173.16. You're right on the number. So let's see what goes on here. Okay, on a 1-day basis, probably turned up. There you go. Well, tried to turn up. Now it's right on the line. So you got it in a little bit of a quandary of 172 and 70 and 173. Now it's above it right now. So again, yeah, it has made the turn down here 172.50. Okay. Again, I would be concerned that January, February, and March may be different than it is now, or even next week or by the end of the week if they want to have tax selling or some type of harvesting. Okay, but again, keep an eye on it to see if it makes a turn. IGV, that's your software. That's another one that's gone nuts. But again, this is something I've been aware of for a long time. This is not a new story to me. You see, even on the monthly, it told me to get in 280. On the 5-year, what did it tell me? Down here at 260. What did it tell me on the 1-year? 1-year turned up at 340. Okay, I mean, this thing's been, this is not a secret. Look at it, ride the red line all the way up. No problem. All right, now what about? But again, ooh, I think I saw a little divergence here. Let's take a look. RSI's at 82. Where are we at RSI now? 67, 72. Still much lower than 82. That what makes me think it's running out of steam. Now, my thinking it's running out of steam, and 25 cents gets you to paper, used to get you to paper, right? The bottom line is I have no price evidence with the red line saying that it's rolled over. And until I do, I'm not going to get selling it because you know what? A divergence can last for long, just like reversion to the mean. That's definitely going to happen at some point. But what? There's no clock on it. So that's why you need to have the moving averages telling you it's rolled over, in confirmation of that it ran out of steam, in confirmation that it's doing a reversion to the mean. Okay, you need the combo. All right, so that's what that looks like right now. Let's go over to the small caps, which everyone is dancing in the street with, because obviously they do have low valuations. They also have 40% of the companies making no money. So obviously there's a reason why they're cheap, because these are not exactly the IBMs and the Nvidias of the world. You understand what I mean? And they're very interest rate sensitive, so they're also getting a little bit of an early buzz off of we're cutting the interest rates. But clearly, look, on the 20-year basis, you should have been buying it against near purple at 160 if you wanted to be, buying against some support. And then when you got what? You got to the 5-year graph, it turned up where? Right here at what? 174. So you should be in there for 20 bucks already. And what about, let's look at the where we are here. Yeah. And look at the blue line. It's holding a blue line. So right now the blue line comes in at 197. This thing starts trading under 196.91. Again, that would mean that the blue line's holding it up. On the 1-year graph, like I say, this thing gave you the buy at 166 and you're riding it up. Is there gaps underneath? Absolutely. Is that making it for a risk of pullback? Absolutely. And the enthusiasm, we're up at 80 on the RSI. All right, let's talk about the 1 month. Again, you got the gap there, but you don't have the red line turning down. So, I got nothing to hold on to as far as, I got suspicions, right? 83 on the RSI, and these other RSIs are much lower. So obviously I've got suspicions that this thing is running out of steam, but I got to have something to hold on to. The red line here on the 5 days giving me something possibly. So, if I was an aggressive seller, this is all bunched in right here, right? You got it all bunched in. So if this thing can start trading underneath the 197, well, it's not trading underneath it now pretty good. Look at all those numbers on the box. 197.29, 197.67, 197.54. So it's already making its turn, but they're not pointing down. They're just flat. So this thing could go right back up again. If we started trading 196 and these averages start turning down and you're an aggressive trader, you might want to take a shot at some shorter term puts and see if you can catch a ride. Okay. So that's basically what the Russell looks like. Let's just take a look at the options real quick and see if in fact we can just get an idea. Say it was going to drop down towards 195. These options expire already, so let's go to the 12 Friday is what, 12/22? 12/22. So let's go to the Fridays and see if there's anything on the short-term gambling list here. Obviously, both calls and puts are getting whacked here today on this. because obviously they got juiced up last week. You know, when premiums get big, and then the market slows down, those premiums come in. You know, those time premiums and volatility premiums. It's called implied volatility. Okay, so anyway, they're getting smacked. So if they're getting smacked, maybe there's better value here now, right? So where are we trading? We're trading at 197. Let's say you think it's going back down towards 195 or something like that. Uh, yeah, these premiums are still so large. They got so large that they're hard to work with. Not unless you're going to get a pretty good drop towards like 190, towards like 190. Can you really see any? Well, if you went down to 191, the 195 puts going for 121 bucks could go to 400. So if you go down to 191, so there is some upside to something like that if you get a nice sharp drop to give some of this stuff back. Now, if it's going to go through the roof in the end of the year stampede, let's take a look at that. 198 calls are going for 131. So if you went to like 201, 202, then this thing could go from 131 bucks to 400 intrinsically. Again, you take your target price minus your strike. That's going to be your potential gain if you hit the target price. Obviously, the risk is the premium if it goes under the strike and the time runs out. So basically, you know exactly what you're risking to the penny, and then volatility will determine what you can possibly make. Okay, so that gives you a little bit of an idea. I didn't like that so much. Premiums still look pretty big. And the fact that the market is only down a nickel and these premiums have collapsed would give you a very good illustration why you can't buy after the fact, either calls or puts, because if the market stalls out after a big move, these premiums are juiced to the gills and they're going to come down. All right. All right, let's continue on here and let's get to everything so I can help you here. All right, so where are the values here going into the new year, right? Well, let me just give you a couple of ones in the news here. NEO's in the news. Let's see what NEO looks like. NEO's up good here today, and it looks like it's on a roll. Gave you the buy signal at 740. You should have the rake in right now at 834. What's it look like on a 1 year? Running into a wall. See, this is why we look at the other charts, because purple is a problem. That gap is a problem too. Maybe that's where it wants to go. So if it got above purple, I would think maybe it's going to go for that gap. So I'd keep an eye on that. 5-year basis. Again, this thing's been in the toilet. It's got nothing but a wall of voodoo above it. All right. Let's take a look at these things that just joined the S&P. I'm sure they've been fronting around a little bit here. Let's take a look. These guys joined the S&P today. Yeah, this is called buy the rumor, sell the fact, right? Buy the rumor down here, 46, boom, sell the fact. Let's see where you are up here. Yeah. See, you got a buy signal down here at 42 bucks, joins the S&P. Now, you know, it has not given you any sell idea, but it certainly looks like it might have, again, if it starts trading under 61.50 and these lines start turning down, these people are going to be left holding the bag. So anyway, on a short-term basis, because again, you had a nice divergence. Let me show you again. 72 RSI, then you got 52. Running out of steam, and when it runs out of steam, sometimes that's when it makes a turn. So keep a look, but you need these lines pointing down. You don't have that just yet. Okay, the next one is Builder First Source. And again, the housing thing's going again, because we have a shortage of houses, I guess. But again, another buy the rumor, sell the fact here, maybe, huh? Yeah, see, builders, and look at this. You got 80 here, right? That was in July. And now your RSI up here is 67. You get it? That's called a divergence. That's what makes me nervous about it. And then basically on your 1 month has not turned down yet. So probably maybe some more back and filling. But again, when and if the red line turns down, then I would be more concerned about it. Obviously, if you're a short-term trader, you got to sell at 168. You know, if you bought puts at 168, now you're at 160. I'm sure you're making good money on those puts. So, like I say, if the long-term charts gives you the indication that it's running out of steam, and you can see something on a short-term chart rolling over, that's called the double whammy, and that's where you can shoot the ball, right? Okay, and then when you start pointing down and it starts going across all the different averages, now you know you're onto something. Right now, you're right at a very critical point. Remember, I tell you 40 is a key number. So right now, if this thing breaks 160 and the RSI breaks under 40, this thing's probably going to 154. If not, you're looking at a low point. Okay, next one is JBL, JBIL. Jabil. If I told you I know what these guys do, I'd be lying. Okay, but obviously they're a good company. There's 9,000 companies out there. I can't follow them all. 75 was the RSI. This high was 60. That's not a good sign. So basically, little divergence on the RSI. I don't like that. The 1 year, again, you got a gap there. See how it hold purple? So that's where you want to take your shot at 115. Okay, that's where you do your buying, not up here. That's it. Up here, you're giving liquidity. You see, smart guys are buying here, and they need dumb guys to buy the stock. So that's the guys buying up here. I don't know if it's going to keep going. Maybe they're not so dumb. But these guys down here need somebody to buy it up there so they can cash in, right? Okay, 1 month. Again, nothing telling you that it's definitely rolling over except the 5-day. And the 5-day right now has an RSI right around 40. Both of these things could easily be just pulling back. The time to act would have been up here. Take your shot, cash your chip in right now. Okay, so those are the 3 ones that are in the news. The other one is the one that I've been telling people about for 3 years. It's called U.S. Steel. And U.S. Steel's been going very, very, very well. And I'll show you why. Okay, this is why I told people about it a long time ago. You see, this is called a rounded RSI. I mean, a rounded moving average. So you buy against it, and you could buy it in 2022 for a nominal sum of $17. Then you could buy more in November 2022 for about 19 bucks. Notice you're buying higher as it keeps going higher. Then you get another one here at 25. Then it gets above the red line, which is pointing up, and you should be loading the wagon at 25. And right now you should have your big rake out and you should be making good money. So that is US Steel. And that's the story on US Steel. That's the story I've been telling for people who want to listen. Okay. So, and they just got a big buyout offer from Nippon Steel. If you want to know why it's jumping today. All right, so that's the story on those right there. Now I'm going to go over here and I'm going to show you some things that may look good for next year. First, let's take a look at the price of crude oil. And we will take a look at the price of crude oil. And you are looking at the price of crude oil up very nicely. And I'll show you why. Because I've told people they should be buying it at 68 if you are a buyer. You see against the purple line here, guys? Okay, now what did it just hit? Oh, it just hit the purple line, right? And what was the low in November? It was on this contract 72.16. Where are we here? Excuse me, 67.71. And the purple line was 68.80. Pretty much right on the number. And now it's basically coming against it. And if it gets above 80, it's going to be very, very bullish. It may not get above 80. But if they don't, here's the story as I understand it. Saudi has got the cuts going on. If demand doesn't show up by after the first quarter, because the US is pumping so much energy, goofing up OPEC, what is happening is that there's a risk that Saudi would open up the spigots in Q2 and flood the market and make the market tank through 68 and maybe bring it into the 50 or 40 because they'd like to get it under 60 because apparently under 60 we would stop producing as much because it's not profitable. So that's the story on crude. If demand does pick up and with everyone going nuts with their spending and everyone having a job, maybe demand will be good. But if it's not, that's the risk. So let's assume the demand will be there and that the prices is possibly going to be able to get above the red line, which is at 77, and start turning it up like the blue line is pointing up still, right? So if we get back above the blue, which is around 80, that's why I'm using the number about 80, and then get above green, which is around 86, then you could see maybe $100 crude or 110, right? unless there's no demand and the Saudis flood it and they want to tank it to kill the US production. That's the risk reward. Sounds kind of binary, so it could be kind of exciting. It might be time to take option positions in the oils so that if it does tank, at least your risk is limited, right? That's the way I would see it. What stocks would be the ones to take an eye on? Well, here, I'm just giving you a couple here. Devon Energy has been discounted quite a bit. You see, it's right on the purple line. This is where I'm taking a shot. Okay. Now, what about MRO? Okay, came down to purple. That's where you take your shot. And if you can get back above 25, it'll be in good shape. How about Occidental Petroleum? I mean, the guy in Omaha, he can't buy enough of this stuff, and he just bought another company. And this is one that I've been very much a believer in. And take a look at it. You see it hit the purple line. That's where you take your shot, right? Right there. And where's that? That's at 55, 56 bucks. It's only $3 away from it. And again, if it gets moving, it's got a lot of real estate up here. So this is interesting to me too. That just gives you a couple. I got a lot more. Let's go to the next thing here. So you get the idea on energy? Okay. Now let's take a look at gold. This is something that I've been positive on because, again, but I'm also not unbridled positive on it, and I'll show you why. Okay. First of all, on the 20-year graph, it came down to the lines here, and that's where I said, this is where you want to take your shot. Okay. Then got above here, and look at the red line pointing straight up. Okay. You took out the highs. Here's my problem with gold. The high here is 83 on RSI. The next high is 60. Remember, if you can't get through 60, you're not getting to the acceleration phase, and that could be the top. Bam, to the downside. Up here, we went up to 59. Can't get through 60, could be the top. Boom, down to 1800. Now we're back up here, and we're at 59 again. This makes me nervous. Why? Because if it can't get through 60, you're not going to go to 2200 or 2300. You're going to have a big correction. Okay, so that's why you got to be careful, and that's why a limited risk option would be the only way I'd be interested in it, because when these things do tank, like oil, like gold, you don't want to be left holding the bag. I mean, to give you an idea, ExxonMobil went to 120 bucks. People who bought up there, I had puts all the way. I could show you why, but the bottom line is that you see, you bought at 120, you're holding the bag. Now you got to get on the Pritikin diet. You got to do sit-ups. You got to eat fish every day, maybe vegetables, because you got to live to 120 years old, maybe, to get the money back. Who knows? People who bought what? GE in 1980, they're not getting that money back. Okay, they can change the price of the stock as many times as they want. IBM is another one that has gone about 15 years, and if you look at where it is, it hasn't done much and because of that high point. So you got to be careful when you get into these things at a very high point. If you bought Zoom and Teladoc or all those other stuffs at the all-time high, getting your money back, good luck on that. So anyway, let's take a look at gold stocks that look like things that I thought are positive. Now take a look at Gold Fields, right? Buy the heck out of it at 8, right? Then you buy some more at 10 because it turns up. And then you ride it. And now you've got a rake and you can take money off the table. Okay. There's a lot of real estate up here if it keeps going. But if you buy when it tells you to buy, again here, not tells you, but when the indicators are telling you maybe it's time to act, that's the time to enter. You know what I mean? Pull back here to 12 bucks, or excuse me, pull back here to 880, $9 or 10 bucks. That's it. Another one that's been very good to me is Harmony. This thing was going for like $3-4 bucks. Everybody got 3 or 4 bucks to throw at something, right? So right here, it tells you to get in at 3 and change, and tells you to load the wagon here at 4. And now it went to 6. Nothing wrong with that. And then the thing that makes you concerned on gold is, where's Newmont? Because, Newmont's a big deal, and Newmont's chart doesn't look very good, really. So let me show you. You see, Newmont's chart still is way down here. Now, I had stuff going on up here, but again, when you get this far away from the moving averages, it's going to come back to the mean. It's going to come back to the mean. So the bottom line is this has me a little concerned, because you'll notice that if gold's going to go flying, this thing is generally in an uptrend and doing well. Right now, this is basically a fighter that's gotten hit in the head 27 times, and it's just gained its feet. And there's these 2 fighters up here ready to punch him in the head again. So the bottom line is that what makes me concerned about gold. we're in that 60 neighborhood on the long-term graph, which is an area of topping. And B, some of the big guys like this guy doesn't look very good. And on silver, Pan America, doesn't look very good. And so, when we're flying on silver and gold, these boys are generally on the train, and they don't look like they're on any train right now. So you got to be concerned about it. Okay, let's talk about emerging markets, because again, if we're going to drop interest rates, if the dollar is going to drop, then emerging markets are supposed to be doing pretty good. I've been bullish on emerging markets for a long time. Let me show you why. First of all, Mexico. Why Mexico? Excuse me, Brazil. Let's go to Brazil. Again, really a lot of problem right there, but it is trying to turn up. I'm not as positive on this place because their political situation seems to be a nightmare. But again, if you want to be in this thing, you should be in this thing at 31, 32, and you should be trying to see if it'll ride through it has to get through. It has to get through purple. So right now, line in the sand is 36 and a quarter. You start trading above 36 and a quarter, and you get these lines here, blue, green, and red above purple. Now you're going to be talking about a substantial gain. So monitor this thing. Let's see if they can get the thing above there. Otherwise, you might dodge a bullet by staying away. Mexico has been doing great. And obviously, we're near shoring, which is a positive thing. But this is no news to me, because this thing's been positive to me since 35 bucks a share. So this is no news to me. And then again, down here at 45 bucks a share. So up here at 68, again, these, you want to start buying here, you're going to provide nice liquidity for people who need people to buy at high prices because they bought at low prices. And that's not my game. Again, extended, too high to buy, too strong to sell. That's the story. But that's one you want to watch on any kind of pullback if you're bullish on what? EM. The other ones that seem popular is this Japan. Why Japan? Because, again, whatever they're doing to their currency, by the way, their currency has lost half of its value. So if you want to know why people like gold and crypto, is anybody in Japan who's just held onto their currency has half the money they used to have as far as currency. And that's a big drop. And I think it's lost 30% in the last year or two. So again, you can't keep printing and buying your own debt, Again, though, this looks quite like it might want to go someplace. And again, it's above purple. If you look at the 20-year graph, again, everything is saying that it looks pretty good. So Japan and Mexico are two of my lead horses as far as that's concerned. If you think Europe might be good, you can always take a look at the ETF for Europe. And then let's take a look at that. It's a one-stop shop for Europe. And so you've got, it looking like it's pretty good. Looking like it's pretty good. So you got Europe, you got EM, and EM, you probably want to do EM, maybe ex-China, but EEM. Again, still got a wall of voodoo right above it there. I don't like that. Yeah, that's why I say, it looks good for Mexico, it looks good for Japan, and then India. 9 trillion people they're trying to sell cell phones to. That's not a bad deal either. So as you can see, that looks very good, has looked very good. We've been bullish on it, obviously, for a long time. So again, India would be another way to go. Okay, also natural resources. I got to hop here because we're running out of time. Freeport-McMoRan is one of my favorites. If you like the copper, why not? Here's your 20-year graph. Trades very nice against the lines here. So 35 bucks area was a good time to enter. And then this thing here, again, there's your 35 buck entry level. So it is looking fairly good. Gets above 45 and it could get rolling again. And so keep an eye on that one for your industrial metal. Cleveland Cliffs is another one that people take a look at for those industrial metals. And again, that one is breaking out. And I've been telling people to get involved with this for a long time if you're interested, because there's your 20-year graph. Looks an awful lot like US Steel. And so those are the ones also for next year that look like they've got some hop to them. All right. Income. I got a few minutes left. I'm going to give you. You want to get, the money market's at 5.5%. It's not going to last forever, according to what these people tell me about cutting rates, right? So obviously, you're going to be forced out of there at some point if you want to keep your income stream. So where do you go? Well, let's take a look at a few things. If you think that these interest rates are going to be dropping, extended maturity may have value. Let's take a look at the ETF over there at Vanguard. You can see the RSI hit 22 and then the RSI hit 25. That's a divergence. That's why you're popping. Got a lot of resistance above. Okay. But I mean, talk about a thing that dropped. It went from 190 down to 60. These are treasuries, but they're extended duration. So there's there's a lot of value down here. If this thing is really, if they're going to be cutting 6 or 7 times, this thing is not going to stay down here. That's my view. Okay. So that's the story there. This is extended duration, meaning very long-term debt. And obviously, it's already made a turn. So you got your buy signal at 64. You're only up to 80 if you did the 1 year, right? So it's already turned. But how much potential does it have? If they're really going to bring rates back down, it's got potential pretty good. Okay. And that's the EDV for extended maturity. You want to look at tax-free stuff? Vanguard's got one here called extended, longer term tax exempt. And you can see double bottom here, 24 there and 47 there. I guess that was the time to, take a shot. Even 32, right? At the bottom, you got 24 and then you got 32. So this thing's gone up 9% and you get the income. So your principal went up 9% because $10 to what? 10.90 is 9%. And then basically you also get the income. Not a bad deal, something that I've been aware of for a long time. And people who talk to me, they'd be aware of it too. VWEAX, this is high yield. Okay, now high yield is risky, right? So look at the 20-year graph though. You went down here to 29, couldn't come down here. It's back above here. You got your buy signal here at 520. So you get in here at 520, it's now at 540. Your principal is going up and you're getting high income from high yield bonds. And again, you get prospectuses on this stuff and you look into it deeper. But again, if you wanted to play high yield, this is a diversified approach. Okay. It's a product for those who want to buy into the higher yield. And on the 1 year graph, you got your buy signal way down here at 504. So really, if you're, this red line's been telling you get in the ball game for a long time. Okay. And then last one here is going to be if you want to get 2 to 3 year paper or short, European, don't forget they had $17 trillion of negative yielding debt. So it might not be a bad thing to look at European debt. And here's corporate bonds from with a European slant. And this thing obviously also has taken off on a 1 year basis from 114 to 119. But what kind of potential does it have? Let's look at the 5 year graph. It's running into steam here. So obviously this is not the place to initiate anything, but if it can get through here, or if these things are really going to be a decent place to be, there's a lot of real estate between where it was and where it came from. So keep an eye on these things. Now we're at the top of the hour here. And, frankly, I went over a lot of information because I guess I hope I've impressed you that I know a lot of information. And the reason I do, it's been my job for decades. So if it's your job, I always tell people, if you brought me to your job, I'd probably look like an idiot because obviously I don't know anything about your work, but I do a lot about my work. And so basically what I'm saying here is this. If you go to my website, optionprofessor.com, OPTION professor, PROFESSOR.com. You can put in your information. I can call you back and I can see what I can do for you in all areas of investment, as you can see, and I can share my opinions and knowledge with you. And then we can work out something about what you think is fair as far as some type of compensation to me. So we can negotiate that and make it, if you find out that nothing I talk about is of any value, you pay nothing. So that's the way I operate, which is obviously 110% different than everybody else, which is promising you a bunch of stuff that you'll probably never get, and then basically charging you up front thousands of dollars. Then you walk away with what? Not what you hoped for, and a lot of money out of your pocket. I know that's what happened to a lot of people, so I'm not interested in doing that. I'm interested in talking to you, explaining how I can help you in different areas, inform you, educate you, get you to be smarter, and then basically we can discuss what's a fair compensation that you can live with if you think I'm delivering value. So again, Option Professor, OPTION Professor, PROFESSOR.com. Put your stuff in there. I'll call you back. Or if you want to call me directly at the office, 702-873 8038. Again, 702-873-8038. Okay. And you can talk to me directly. Give me an idea of, if you're just starting out, I know how to explain the basics to you and explain the uses and the risk of the options and all the strategies. If you're doing things elsewhere and you want to talk to somebody who doesn't have a vested interest in what the heck you're doing, that would be another thing people come to me for. If you want to see exactly how these indicators work and how I interpret them, because obviously I gave you a very, very fast presentation today, we can do that. And then, of course, if there's other questions you have on different things, I feel like I'm a fairly informed person, so it's not the worst source to get some information from. Again, I don't give advice. That is the job of your broker. That is the job of your brokerage firm to determine what's suitable, what's not, and again, and all trading. So I just share my opinions and I share my knowledge. And obviously, you can either use it, lose it, or don't do anything with it. Okay. But again, that's how you can get a hold of me. Optionprofessor.com, put in your information, or just pick up the phone, 702-873-8038. All right, I'm Jim, the Option Professor. I think I gave you quite a bit to chew on here. I got a big year coming up in 2024. It's going to be very exciting. Happy holidays, everybody. Merry Christmas, happy holidays. And I'm going to be in New York City for the holidays, so I better bring a nice warm coat with me because I'm coming from Nevada, which is a little warmer than New York City. And it looks maybe an umbrella wouldn't be a bad idea either. All right, guys, thanks for coming and look forward to hearing from you. We'll talk to you down the road. Have a good day.